Well, welcome to this edition of our Thought Leaders series. I'm Joel Hefner. Today I'm joined by Professor Marco Maggio. Very exciting topic today on all things fintech related. In fact, we're going to focus on three main areas: blockchain technology, cryptocurrencies, and of course DeFi. A couple quick housekeeping items you should have in your Q&A. You should be able to type us in a question. Feel free to do that if you have a question during the webcast. We'll do our best to get to it. I will say, though, there's quite a few people on the webcast, so if we aren't able to get to it, we'll make sure we do that afterwards. Now, I'm going to go ahead and introduce our main speaker, Professor Maggio, right now. He is a professor at Harvard Business School in the finance unit. He's also works for NBER, National Bureau of Economic Research, and has been involved in several cryptocurrencies projects as well. So, Professor Maggio, welcome back.
Thank you so much for having me. It's a pleasure to be back.
Awesome. Well, and a couple final things. If you are a CPA or a CFP, we will be issuing credits, CE credits. So you will be prompted 3 different times throughout the webcast. You need to make sure you stay on for the whole time there. Very quick, simple question. Go ahead and type in that answer, and we'll be sure to get you the credits. Also, I do want to make one other mention. We will be showing slides today. Professor Maggio has some slides he'll be showing. Fortunately, given the nature of the audience today, so this has, of course, financial advisors, institutions, some folks maybe retail or direct clients as well. We're not going to be able to issue you a copy of this slide. So apologize for that in advance. If you type in, say, I'd love a copy of the slides, I'm sorry we won't be able to give them to you, but you will be able to, of course, follow along. And we'll be going through everything at that pace. And again, any questions, feel free to get those in. So Professor, as I kick it over to you now, as we always say at Dimensional, there's really 3 main things we talk about as it relates to an asset class. In fact, we oftentimes say here at Dimensional, what role does an asset class, of course, play in your portfolio or an investment? What is the expected return of that investment? And of course, what are the costs to get in and out? So from that framework, I'll kick it over to you with the first question we were debating here internally a little bit. As it relates to crypto, is it its own asset class? And if so, are we missing out by not directly investing in this asset class? So how would you address that question?
So thank you for that super interesting question. So I will say that one interesting thing here is that probably not many of you know, but you are already exposed to the underlying technology blockchain, because there are more and more companies nowadays that are using the underlying technology. And so, just a few examples, Tesla by owning and accepting a Bitcoin, MicroStrategy by owning Bitcoins. And then I will touch upon some more, even more standard companies like Walmart. I'm going to give you a couple of examples that are using the underlying technology. And so even if you don't own a Bitcoin in your wallet or in your portfolio, you are likely to be already exposed to the underlying technology. So I will go ahead and just show you a couple of different takes. As usual, these are my own views, not the views of Dimensional. But let me start with 2 opposing views here. So on the one end, you have Tesla and Elon Musk saying that they are buying $1.5 billion in Bitcoin, and they're going to use that use Bitcoin as payment for their cars. I have to say they changed ideas a couple of more times since February. And then on the other side of the spectrum, you have Warren Buffett saying that cryptocurrency has no value. I don't own any and never will. Okay. So I will not try to reconcile these 2 views, but I will sort of try to show you both the potential benefits and the potential risk, both for investors as well as risk that comes from regulatory risk and so on, that might motivate why there are such opposing views in this space. Okay. Before talking about crypto, let me start with the underlying technology. Exactly what I was telling you before. The underlying technology is much bigger than just crypto. And where it all started, with this idea of creating a record. They think about it as database, a ledger that is public, immutable, and it cannot really be counterfeit. And one thing that we need to acknowledge here is that we are very much at the infancy stage. We're at the proof of concept stage here. And so many of the things that we are seeing right now are sort of experiments. Some are going to work out and are going to be, scaling up and are going to be extremely successful. Others are going to fail. There are going to be also loopholes. There are going to be also risk for investors. But sort of the idea is acknowledging the fact that this has been around for just a few years, for a decade or so. Why it has the potential and should attract the attention that it is attracting as the underlying technology is because it somewhat complements the internet. As of now, the internet is all about sending information without a central intermediary. The idea of blockchain is really creating an internet of value. So transferring asset without a central intermediary. Okay? That might change dramatically the way in which we interact with each other. And so the applications that have been explored are in multiple different areas. There are some obviously in cryptocurrency, and we're going to talk about that. There are some in decentralized finance. We're going to talk about that at the end of the talk. And some in NFTs that are, these non-fungible tokens, which is another new experiment that has attracted a lot of attention. But before going there, let me emphasize what I was telling you at the beginning, which is that at some point you are likely to have already some exposure to this sector. Why? Because of companies like Walmart, with, for instance, now using blockchain to bring transparency to the food supply chain. The idea was, how do we trace products that are coming from other countries into the US, for instance? And if they did an experiment that they were trying to trace, mangoes, and it took them about 7 days to understand from which farm, which country these were coming from. So they said, 7 days, it's better than other places, but it's still extremely slow, because think about what happens if there is a foodborne disease and they want to trace it back immediately to the initial farmer. They used the underlying technology provided by IBM blockchain, and this was what's called the Hyperledger. And in this way, they were able to shrink that 7 days into 2.2 seconds. So immediately, they were able to trace it back to where it was coming from. And so now they are rolling these out across different type of products. That's not the only application. They have been used to monitor vaccine distribution in real time. And then the last one that many of, I think, the people that are in the audience have heard about is using Bitcoin as a legal tender in El Salvador. Okay. The strange thing there that I would highlight here is that 70% of Salvadorians don't really have a bank account, and just 1/3 use the internet. So it doesn't seem to be really the place where you would do something like that, given the technological barriers. But obviously, there is a lot of demand for something that is outside. It doesn't need the trust in a central authority to have some value. So let me do the transition towards the first application we're going to talk about, the cryptocurrency. Okay. This is really, I would say, welcome to the Wild West, just because, as you can see from this graph, which plots the total market cap of the industry as well as of the top cryptocurrency, with the orange-yellow area being the one of Bitcoin, and then the second largest one, Ethereum, and then you have the others like Cardano, XRP, Solana, and so on. These are sort of large cryptocurrency that have attracted a lot of investor attention. And as you can see, there is quite a bit of volatility here. It is an industry that reached about $2 trillion in about 10 years, but is still going through, as I mentioned, an infancy phase. What's the underlying challenge here is trying to find a system or mechanism by which a common set of facts can be agreed upon. And this is really what all of these cryptocurrencies are about. We have to agree that some transactions are happening and some are valid and some are not valid. And this is sort of the main innovation of the underlying technology, trying to find this consensus mechanism that we can use to agree on this set of transactions. Bitcoin has a proof of work, which is environmentally definitely not friendly, extremely expensive. Others are coming up with what are called proof of stakes that are significantly more friendly to the environment because they don't consume as much energy as Bitcoin. And as you will imagine, as we scale and as this industry grows, you would expect more and more of these type of innovations that use the underlying technology, but improve them along some of the lines where we see the most inefficiency. For instance, the consumption of energy. Okay.
Hey, Marco, can I ask real quickly? There were a couple of questions that came in around that topic, around scalability. That seems to be one of the challenges some of the blockchains have had. Is it more because of the mechanism, whether it's proof of work or stake, or what are you seeing as it relates to scalability? Because ultimately, you've got to be able to process an awful lot of transactions to make this work in a very short amount of time.
Absolutely. I would say that there are two main roadblocks there. One is making all of the consensus mechanism making more environmentally friendly. And the other one is the number of transactions. Just to give you a sense, the number of transactions for Bitcoin is around 4 per second. The reason why is because every single block, which really contains these transactions, is limited in size. And it's limited the number of blocks that can be approved in a certain amount of time. Just to give you a comparison, beside the peak of time, they use about 4,000 transactions per second, but they could potentially handle 10 times larger number of transactions. So there is a huge difference. Okay. Now, one thing that, just to be fair, that we should say is that these have been acknowledged, these type of roadblocks, these types of barriers to scale, and there are now innovations that try to overcome these type of barriers. In particular, now you have blockchains that allow for thousands of transactions to be processed per second. Solana is one of these. And you also have systems, like I was mentioning, that are significantly more environmentally friendly. And so they don't consume as much energy and retain the same efficiency in terms of agreeing on these transactions. Okay. So just to wrap up that reply, I would say, yes, there are big issues, but at the same time, this is an industry that is evolving. And so those issues are being taken care of as time passes by. And there are already a couple of different answers to those issues. Then I will add one more, which is sort of the way in which I will talk about this slide, which is the biggest issue in using any of these cryptocurrency, at least the ones that people are familiar with, is the volatility. You don't really want to use as a mean of payment a currency that changes value every day, okay, or even every hour. And so that's also something that has been proposed, and it's really is taking off quite dramatically in the last few years, which are stablecoins. So they are usually pegged to a fiat currency. For instance, one USDC, which is one of these stablecoins, or one Tether, is worth $1. How those work? They work in different type of ways. The one standard one is that they keep reserves. So meaning that for every $1 worth of the cryptocurrency, they hold the $1 in treasury bills or in cash. Or they can be more sophisticated in terms of creating this stability. And without going into the details, but there is the possibility of also creating these stable coins using algorithm. So they don't really have reserves, but they provide the incentives to the players in this industry to keep it stable because of arbitrage. And this is actually an area that I've been involved with multiple companies. And so if you look at this space, you have the cryptocurrency that holds more than 6,000 different coins, and then a subset are the stable coin. And then even a smaller subset that is right now emerging, and I will spend some time on, are the CBDC, so the central bank digital currency. So just to give you a sense of some headline numbers and a sense of this industry, these are the cryptocurrency. As I was saying, there are 6,000 of them. And the three major ones are Bitcoin, which is also the first one, represent about 40% of the total market cap. Then there is Ethereum, and Ethereum is a completely different cryptocurrency. And I want to spend a minute on this just to show you how different these different currencies are from each other, although they are usually bundled together. Bitcoin, the only value in Bitcoin is really given by some type of speculative demand and some expectation that the number of Bitcoin is limited, because that's true. So the total supply is limited and will run out in the next few years. Ethereum instead has built the underlying blockchain, and why it has value, it's much closely related to use cases. Meaning you have this technology, and to really use this technology, the Ethereum blockchain, you have to buy Ethereums. Okay, so you have to buy the underlying currency. And so the more developers are working on different apps that are plugged into this ecosystem of Ethereum, the more you would expect the value of Ethereum to go up. And so that's the reason why I was saying these are very different cryptocurrency. One has a limited supply and doesn't really have an ecosystem around it. Ethereum has unlimited supply, but its value really comes more from the use of the network, use of the underlying technology. And in fact, most of the that we have seen in the last 12 months in the decentralized finance protocols are all linked to Ethereum. And then you have also Ripple, which is even a different model. Ripple is much more of a centralized company that has funded a cryptocurrency with more specific use cases. Like, for instance, the difficulties to transact across international borders that is very slow as of now and is extremely expensive. And so remittance is one of their main use cases. But as I said, it's very different there as well, because it comes from a company that is proposing this, rather than being completely decentralized as the other two. Stablecoin, as I was saying, very different. Here, the idea is, let's take seriously the thought of using cryptocurrency as a means of payment. And to do that, we have to propose something that is stable. Okay? Stable with respect to what? Usually respect to other type of currency. There are, I will mention three of them, which are USDT, Tether. This is backed by fiat money, cash equivalents, and receivables. USDC, very similarly backed by fiat money, and publish audit report on its collateral. And DAI, which is run on a decentralized protocol and backed by other cryptos. I'm also plotting the performance, let me call it, the price of this currency. Although they should be stable, they also went through some times of volatility. Although if you look at the scale, we're still talking about being a few cents around $1, which all three of them are linked to. One extra thing that I want to mention here, which sort of opens up a lot of other questions in terms of the regulatory framework, is who checks what type of reserves this type of stablecoins have. Okay. In fact, there has been very recently quite a bit of controversy around the USDTs. Why? Because they found out that there isn't much transparency. So after a lot of pushback from the SEC and other authorities, they found out that the Tether, so USDTs, owns a lot of Chinese commercial paper in their reserves. And given the latest issues with some of the big companies in China, that's definitely not a sign that you would have that's definitely not something that you would like to have and see for a stable coin. And so there is a question of stability, but at the same time we want to make sure that there are reports and there is transparency around should we really trust this stability. Also because these are not savings account, these are not, there is no FDIC insurance. So if I own a USDC and then there is a drop in its value, it is as risky as holding any other type of currency. Okay. And then I want to give you one specific example that some of you have heard about, which is Facebook Diem, which formerly was called Libra. So, even private companies have started thinking about issuing their own cryptocurrency. I will tell you why in a second, but let me first tell you sort of why, what this is really. And so thinking about building the internet of money for everyone, this was the plan. having 2 billion people that currently use Facebook or Instagram or WhatsApp, and having an embedded payment system with their own cryptocurrency. This was basically designed to have a friction-free global digital currency that will reach everybody that has a mobile phone, with even those that don't really have access to banking. Because remember, there is some demand for that. There are about 2 billion people around the world that own a mobile phone, but don't really have access to banks, don't really have access to a checking or a savings account. And even this is not just an issue for developing countries, this is also an issue for the US. The FDIC says that there are about 25 million people in the US that are underbanked or unbanked. And so this is sort of there is a demand and there is the possibility of reaching these people and offering those people some financial services. This was the idea of launching these payments using these existing app. Diem, so their coin would be a stable coin, and it will be pegged to each different country. So it will be pegged to currency. So in the US users will see Diem as pegged to the US dollar. In Europe, they will see it as pegged to the euro. It's money. It's not really an investment vehicle. And the plan is to have it completely reserved. Okay. What's the issue with that? Is really that if you take this one step further, you are getting to some sort of privatization of money. Right? Up to now, we have thought about money as something that is in the hands of the Federal Reserve. It's something that is in the hands of a central authority that is above everybody, above every single individual, above every single company, and even above the government, because the central banks are usually independent. But here instead, you have the first example of a company that is creating its own currency. What that might bring, it may bring, well, a lot of benefits for Facebook and companies like this. In particular, because with the cryptocurrency where everything is digital, this also means that everything is traceable. And so I can see and follow the journey of each one of these users across different platforms and across different use cases. Meaning, I see somebody on Facebook to whom I can post and advertise an ad for a product. And then I can follow the same user when they take their DMs, their Zack back, and they use that to buy that product. That will be sort of a full circle that will be worth a lot, because that's sort of the key in marketing, being able to trace the advertising with the end product sales. I'm sure this has been extremely controversial because it's Facebook, but I'm sure this is not going to be the only one and the only company that is actively thinking about this. You can imagine other large companies where they already have a huge user base, Amazon, Apple, Google, thinking about, okay, what's the next step? How can I create it's an ecosystem around what we already know about these users? This has also opened up sort of a lot of questions for central banks. As I was saying, this is the first step in the privatization of money. Central banks were not happy. Okay. Also, some of you remember in the last few months, we had many Congress hearings with Facebook representatives, with regulators, thinking about what are the risks of having a private currency used by billions of people around the world. But the proposal like the Facebook Diem has also needed its own response by central banks. And so central bank's digital currency is sort of the next step here, and is putting together some of the elements that we talked about before. There isn't really any out yet that is fully fledged. I will talk about the Chinese example, which is the closest to be up and running. But what's the economic idea here? How should we think about why running these central bank digital currency? Well, think about the stimulus checks that millions of people have received during the COVID pandemic. All of these will be a direct deposit, and it will not go through the IRS. We have seen many of the issues with the IRS payments. This will be directly deposited on the accounts. You can have some type of universal basic income. You can have some type of data and rule-driven rate adjustment. Think about monetary policy that is not decided every 2-3 months, but is actually driven by what has been observed in the data in the economy. Because you can trace every single transaction once you get to use a central bank digital currency. You can also implement negative rates. And so, saying, okay, I'm going to give you a stimulus check of $2,000, but I'm also going to tell you that you need to spend it. You cannot really save it. You cannot really invest it. I need to see this spent away. Otherwise, you are going to lose 2% per month for every month that this sits on your account. This is certainly a very powerful implementation of negative rates that might change the combination of both fiscal and monetary policy. And then there is also just the data-driven aspect in the sense that you can observe GDP and inflation in real times. As of now, it's incredible, but it's still extremely slow and imperfect, what we can see about the economy. So this is an old idea, if you think about it. So I went back and looked at James Tobin, which is a Nobel laureate in 1987, that argued that in order to avoid relying too heavily on deposit insurance to protect the payment system, central banks should make available to the public a medium with the convenience of deposits and the safety of currency, essentially currency on deposit, transferable in any amount by check or other order. So basically, the people should be able to store value even without being subject to the risk of bank failure. Having a central bank digital currency opens exactly that possibility, meaning that people would have direct accounts with the Federal Reserve or with central bank in general, will not go through the commercial banks. Okay? So that will be a dramatic shift in our economic system. Let me also pinpoint a couple of differences just to show you, again, the spectrum, the breadth of this space. If I compare the features of Bitcoin and the feature of CBDC, Bitcoin is what's called a permissionless blockchain. Anyone can run the software and participate in this network. There is no central entity. And as I said, it's been running smoothly for the last decade or so. The way in which people have been imagining the CBDC are what are called a permissioned blockchain. So instead of having one central database storing all of the financial records, this decentralized ledger can be composed of several copies of this transaction history, each managed by different financial institutions, or what are basically the ones that have permission to participate in this network. And then they can share the data seamlessly. The supply, Bitcoin has a limit of 21 million Bitcoins built into the protocol. It is impossible, basically, to change this limit. On the CBDC side, to regulate monetary policy in a digital world, you will need the ability to change the supply. Okay, and so you would like to remove and add money to the supply, such as to stimulate the economy in a tribal environment. And so these are not really features that are going to change once the CBDC are run. Okay, and so this is sort of the view of really what are the main differences between Bitcoin and the centralized digital currency. Obviously, the obvious is who runs it. Bitcoin, everyone can run the software and have access to it. The central entity will run instead the CBDC. So it's not going to be a decentralized permissionless chain, but it's going to be a centralized permissioned chain, but still might achieve some of the benefits that we have seen in other blockchains. So the one that I wanted to mention that has been running far along than others has been the Chinese one. So this is an experiment that they ran over the summer. China handed out $6.2 million in digital currency to Beijing residents as part of this trial, sort of a proof of concept. The idea here is really, giving away this currency and see how these get to use in the transaction in the day-to-day life of these people. And their point of view has also some strong, implications for us. Why? Because the idea of inserting a central bank digital currency is really about reasserting control of the financial system. The idea is that they have seen with the advent and then the extreme success of Alipay and Tencent, they've seen sort of these markets slipping away from the control of the Chinese government. Digital One will provide a digital wallet, which is going to naturally compete and surpass the private ones. And so these can be used sort of control of the underlying economy. There may also be, there is another type of underlying thought there, which is that commentator suggested Digital One could help internationalize the China's currency. Meaning, as of now, most of the international trade agreements are done using the US dollar. But this is expensive because of all the international transactions that take time and are not cheap at all. The Chinese one might compete with that by sort of fostering a different type of mechanism that is potentially more efficient. But why overall they are thinking about this? Is not just as a response to the Facebook Diem experiment, but it's also because payment might get faster and cheaper. This is not a small thing. We're talking about 0.5 to 0.9% of GDP is spent on payments today. More people can access digital payments. 6.5% of Americans have no bank accounts, the underbanked or the unbanked. And as I said, there is a direct control of targeted payments and stimulus check. So, there are a bunch of questions, and I'm gonna sort of lay them there without, I cannot offer a definitive answer to all of these. But I wanna tell you this because I wanna show you there are still a lot of things that need to be figured out. So we talked about how this might help us on the payment, transfer, and settlement of transactions, especially because of cost, accessibility, and so improving financial inclusion and overall efficiency. How many of there could be? Well, as cryptocurrency, in general, it's likely that we're going to see these three main buckets expanding in different directions. So you're going to have the cryptocurrency that are volatile. Then you're going to have the stablecoin, so the cryptocurrency that are stable and pegged to the dollar or to other currency. And then you're going to have the CBDCs. Obviously, the CBDCs are going to be a national effort. So we're going to have as many CBDCs. We might potentially have as many CBDCs as countries we have. And stablecoin is probably the one where I see more of a convergence towards just few of them. And the reason is because at the end of the day, you want to use this as a window payment. And so, having some type of, as long as they are scalable, having some type of commonality across different payment platforms, everybody using the same stablecoin, it's likely sort of having a sort of a forces towards the winners take it all type of environment. There are questions that are at the periphery of these, but are very much connected to all of this world and are usually also connected when you read about blockchain and crypto, which is how to protect against cybercrime, software outages, malfunctions of distributed ledger. Will regulator intervene here? On the last point, definitely. We have seen, the Congress and the SEC have been in talks about regulation of the space for quite some time now. We're going to see more and more of that. And in particular, this also is going to show how this industry is going to expand. In particular, if I look at the type of investment that venture capitalists are doing right now, they are mainly investing in infrastructure that is minimizing regulatory risk, meaning nowadays, there are companies that might allow and facilitate the way in which know your customer practice can be implemented inside these type of projects. And so those are the ones that, or anti-money laundering type of practices. Those are exactly the things that one needs to make the industry compliant and also scalable. Okay. So these are sort of some of the key issues that are facing right now.
Hey, Professor, there were a few questions that came in as it relates around regulation. Obviously, people have noticed on here and some direct questions. Hey, the Chinese government is flat out just banned crypto altogether, banned its equipment, banned people using it, trading it, etc. What are the opportunities or possibilities of that happening at some point in the U.S., and how do you see that working? Obviously, we're not here to predict future policies, but you may have some insights, at least as far as how this could fit in overall with the structure of what's out there and what regulations may come into place in time.
Yeah, I think that's an opportunity for us to actually innovate and provide a framework that allows for this innovation, at the same time allows for some type of protection for retail investors. And so allowing an environment, let me call it, a sandbox, where some of these cryptocurrencies, some of these projects can run, can try it out, can be tested. I think it's extremely helpful. And also, let me say that the Chinese ban, they've been on this for the last few years. The fact that they've been announcing these for the last few years also tells you that it's very difficult to implement because there is no company I can sue. There is no, central actor that I can go and arrest or I can go and force to shut down the servers. And so it's sort of very difficult to actually implement a policy like this. Significantly better implement a policy that would allow for a minimization of risk for the end users and making sure that both this type of decentralized projects as well as the ones in the old traditional centralized finance are playing by the same rules. That will be sort of an environment where we can get all the benefits, the efficiency, the accessibility, without facing much of the risk that we are facing right now. The fact that right now is sort of the Wild West that I was mentioning before, and the fact that there is so much that is happening at the same time that is very difficult to discern what is here to stay and what is just a scam, what is a blatant violation of security laws. So that is definitely something that is going to change. And the more this industry is growing, the more we would expect those changes to happen very fast. And so I think overall, that's a great opportunity for us to do something better than just ban this. And then if you think also about the few companies that we have had so far in this industry, Coinbase. Coinbase was allowed to go public, and their own business about the exchange is all about this cryptocurrency. So I would expect that would not have happened if there was even a slight probability that the US regulator will go and ban completely cryptocurrency. Is much more, that's, I think, my point of view is that that's much more of an example of letting them run within the framework that we know, within the rules. And so, a company like Coinbase obviously is doing AML, is doing KYC, is making sure that everything runs smoothly. And the last few debates that they have had, for those of you that are following the space, they had a controversy with the SEC about a potential lending program, meaning sort of allowing investors to deposit money, borrowing, getting some interest rates from there. The reason why there was this debate with the SEC is because Coinbase went to the SEC asking for permission to run something like this. Okay. The news of last week is that they've decided for now to put it on hold because they haven't figured out exactly a way of doing it in a compliant way. Okay. I think I mentioned this a couple of times so far. I think it's now time to sort of talk about a little bit more about DeFi. So this is really what's happening. I would say this is sort of the awakening of the blockchain in the financial markets. So the decentralized finance is basically offering a blockchain-based financial infrastructure And this has attracted tens and tens of billions of dollars in the last few, I would say in the last 12, 14 months. And this term generally refers to open, permissionless, and interoperable protocol that replicates financial services that we already see in traditional institutions, but just in a more open and transparent way. In particular, this doesn't rely on intermediaries or centralized institutions. Everything is really enforced by code, meaning once we write a contract, this contract is not only a legal contract, but it's actually a contract that is determined by the code. So once we go and run and execute this contract, it's done it by itself. There is no other decision there. And there are so many applications. One, for instance, you can move stable coins in a decentralized lending platform where you can earn interest. So think about this as a savings account where instead of your 0.0002%, you might get into the single digit or double digits, depending on market conditions, interest rate. You can also add the interest-bearing instruments to a decentralized, what are called liquidity pool. You have automatic market makers. So rather than having a market maker that needs to match buy and sell orders, you can have an automatic market maker that do that by code. These are just some of the examples of things that we have seen, and they have really transformed the way in which we use cryptocurrency and potentially can have spillovers also to traditional finance. This is the picture that I was showing you. I mean, the headline number that I was showing you before. This is a DeFi pulse. This also track the amount of money that has been invested in DeFi applications. And this is, we are reaching $90 billion in just 1 year or so. What are, if we have to distill the reason why we could pay attention to this, are I think 4 main reasons. One is efficiency, then second one is transparency, then accessibility, and finally composability. So why efficiency? Because now if two parties want to exchange digital assets, for instance, thinking about exchanging one of these tokens, there is no need for guarantees from a central counterparty. We don't really need to go through a central counterparty to do this. And this decreases systemic risk and makes the financial transactions much more efficient. Why? Because you are not exposed to that counterparty risk. And imagine that the sort of the peer-to-peer, the decentralized type of transactions only occur, and you only pay if the other can actually deliver. And so these type of contracts are significantly less risky. Then there is a question of transparency. All transactions are publicly observable, and the smart contract code can be analyzed and audited. So it's true that we have seen quite a few examples of companies that have gone through some type of accident with their codes, that have been hacked, and so on. I would say that those are still the exception, even in an industry that is such a proof of concept phase. But the nice thing about all of this is that once the contracts are outside, everybody can look it over. Everybody can come up with the better and improved forms of that. And if you think about bringing this type of transparency into the centralized finance system, this means that there is no more reporting. The regulator can actually observe the transactions in real time. Doesn't need the reporting from any of the institutions to make sure that risk is assessed in the right way. Then there is a question of accessibility. DeFi protocols can be used by anyone. The infrastructure requirements are pretty low. Everybody can run it on a laptop. And so also the risk of discrimination, 0. One caveat to this is that still there is a knowledge gap. And this is honestly something that, given that I am in this business, I'm excited about. I'm trying to fill that knowledge gap. I'm trying to show people how easy it is to potentially open a wallet, how to interact with these protocols, and to what extent these might improve their financial health. Okay. But as of now, it's still significantly more difficult to onboard the people on one of these protocols than it is to open a Charles Schwab's account. And then the other thing is that this type of, when I call protocols, think about really Lego pieces. So they can be all plugged in, and you can have sort of an ecosystem where you can do multiple things at once in a almost seamless way. And this is really the promise of this space. I was mentioning a couple of examples. So interest-bearing cryptos. One issue with owning cryptocurrencies is that many of the... Oh, Joel, you want to say something?
No, you're good.
So one of the main downsides of owning crypto is that many of the crypto holders don't really want to sell because they would like to experience some price appreciation, but still they don't want to keep this money idle. And so what you can do is nowadays you can actually borrow and lend cryptocurrency. So you can deposit in a savings account and get some yields. Okay, this is a whole new industry, which is nowadays called the yield farming, and it's somewhat equivalent to a currency carry trade, in the sense that you pick the interest rate at which you borrow land in order to make profits. Compound is one of these protocols that are offering those type of capabilities. And so, you can own in a capital appreciating asset like Bitcoin, and you can borrow land and get some extra return. Or you can own stable coins because maybe you're using them for something else. Institutional investors might use those for leveraging up their bet on this market. But at the same time, you can deposit and get some healthy yields there. Then I was mentioning automatic market makers. The largest one is Uniswap. So this is the possibility of creating a liquid market. Thinking of all of these cryptocurrencies, 6,000 tokens and more that are out there. One downside is that it's difficult to make sure that the market is deep enough for so many coins out there. Well, a protocol like Uniswap is sort of filling that gap. The idea that, well, if I own something, I would like to make sure that at some point along the road, I'm gonna be in a position where I can sell it without paying too high a transaction cost, without having too much of slippage. This is the automatic market makers offered by Uniswap allows for something like that. It's very simple. It's market order only. It's transparent. You know the public ledger, you can inspect it, what is available out there. And there is what's called a near infinite market depth, in the sense that the price adjusts according to a curve based on the order size. The larger the transactions, the larger the slippage I'm going to have, but I could potentially fill that order no matter what. Higher price, but I will fulfill it. And then there are two distinct roles here, makers and takers. So those who provide liquidity and earn some transaction fees, and those that are takers, those who consume liquidity and pay some transaction fees. Sort of similar also how the traditional markets work. Here I can be a liquidity maker, and I can pick, for instance, a pair of cryptocurrency. I can say, I want to provide liquidity for those that are looking to exchange Bitcoin with a stablecoin. And I'm willing to do that for this price range. And I'm putting down some money. I'm gonna earn fees. I'm gonna earn these fees as liquidity takers are executing transactions in that interval for that pair of currency. Then, as I said, there are cryptocurrencies that are completely decentralized as DAI. The one thing that I want to mention is that you might have heard of what are called governance tokens. And I want to explain this just because this gives you a sense of what it means to be completely decentralized and where some of the astonishing yields come from. Many of these companies, the one, for instance, that I've cited, but many others, have additional tokens that are created by these companies as an additional token to give to their users. What these tokens allow you to do, allow you to actively participate in the decisions of these protocols. So these might determine the direction of the future development. Or should we offer this product or not? Well, who is deciding? everybody who owns a governance token for that particular protocol can go and submit votes about what is the direction they should follow. Okay. So that's really what it means to be decentralized. One caveat there. Obviously, the initial group that is launching the protocol owns a lot of these tokens. So potentially they always own the majority. However, you get deeply penalized in this community if sort of you don't allow that decentralization. People want to make sure to have a voice, and so those governance tokens also have a price. It can be traded in secondary market, and the price of those tokens depend on how much excitement there is in these projects. So if they think that this particular application, think about the yield farming or an automatic market maker or another new application, might really have a lot of user in the future, what you want to do is buying these tokens that allow you to then decide what's going to happen in the future. And at the same time, you're going to experience some capital appreciation. The reason why you can also pay such a high interest on these type of accounts is because part of those interests are financed by these governance tokens. So yes, I pay you, 10% yield, but those 10% is calculated because I'm paying you with tokens that are appreciating at such high rate. Let's also explain, is this sustainable or not? It's definitely to be seen. This has been sustainable right now because there has been a huge demand in this sector, but it's not clear what's going to happen once we are in steady state. So, I would say that one small example that I want to tell you about in terms of the implication is that if you remember all the GameStop and Robinhood episode, well, the DeFi, in some sense, answers the call for a growing number of retail investors who demand to democratize finance. So they are able to trade free of institutions, free of censorship. Why? Because if you remember, at a certain point during those crazy weeks, Robinhood, for instance, shut down trading on those meme stock multiple times. That will not be possible if you were trading on a DeFi application. And now there are DeFi apps that are very controversial, but allow you to trade tokenized stocks. So that allow you to trade assets that are traded outside the blockchain and follow those prices. And that's sort of without any type of control. And that's one of the things that are under the most scrutiny by the SEC. Now, the last thing that I want to conclude with is the other applications. So we talked about blockchain in general. We talked about cryptocurrency. We talked about, in particular, stablecoin and CBDC. And I want to finish with non-fungible tokens. Many of you have heard about what happened with these one NFT called Everydays, which was the collection of 5,000 days or the art produced over 5,000 days that sold for $69 million. Okay. Similarly, the first tweet of Jack Dorsey, the CEO and founder of Twitter, just setting up my Twitter account, was sold as an NFT for $2.9 million. Okay. What is an NFT? NFT is just a mean to commodify the ownership of digital asset. It's basically a piece of code that represents that particular image. So when you buy an NFT that represents a particular type of art, you're not going to go home and hang your beautiful painting to the wall, but you're going to have ownership of that image. And you are going to know whether that image has been used, reused, or bought or sold by other people on the blockchain. In some sense, it's another way of doing collections or collect art without the gratification of looking at it on the wall. But so that's the strange thing of it, right? That we are not used. The digital files, because digital files can be infinitely duplicated at a minimal cost, so it's particularly risky. And there are a bunch of questions that are in the gray area. Does the creator retain the copyright, so they are paid whenever an NFT is sold? Can regulatory art be authenticated through an NFT? And is it sort of a fad or is it something to stay? We don't know, but some of these questions are getting clarified. In particular, there is another famous artist, Damien Hirst, a UK-based artist that has launched the first art piece to his audience through an NFT. And after 6 months, if you have bought this NFT, you can decide whether to actual piece of art or just retain the digital asset. We are still sort of waiting to see what's the demand for something like that. But definitely there is sort of an implication that goes above and beyond art. With NFT, there is the possibility of authenticate art, because for that single piece of code that corresponds a particular image, a particular transaction. So I know exactly whether that gallery bought it from the artist and whether then the gallery sold it to somebody else and then it got to me, so I can trace it back. This is very similar to the supply chain example that we were talking about at the beginning with Walmart. We can do that also for other things, including art. But overall, there is sort of this demand of tokenizing, meaning making digital what is out in the real world. Art is the first piece, but it's not clear that that's going to be the only application we're going to see. So let me conclude with the wrap up on the risk of all of this. So we have talked about carbon emission. So Bitcoin consuming more electricity than Argentina, and we have talked about also the shift between proof of work and proof of stake. So meaning high energy consumption to lower energy consumption. Is the risk premium justified? Definitely there is no free lunch here. The yields are extremely volatile, even the ones on the savings account. There is no FDIC insurance. There is a lot of security incidents for this type of currency and protocols. Anonymity, really a blessing. Well, it depends from which point of view. Angus Deedon, another Nobel Prize, said the only advantage, as far as I can see, is you can be a crook. So there is definitely that as an issue. And then regulators are acting and watching this space. And so there is a question of what's going to happen in this space once the regulator finally enacts some of these rules. And one bad side of having a completely decentralized system is also that the way in which the legislation is going to move in this space is going to be very different than the way in which has moved for the banking sector. The banks have had sort of some type of voice in the legislation over the years. Here, there is no single entity that can go and lobby the Congress for one way or the other. So that's also going to be a challenge for the industry. Overall, we went from $0 to $2 trillion in about 13 years. We have seen a bunch of different applications of this underlying technology, cryptos, DeFi, NFTs. There is a real and tangible benefits that is emerging, and we are seeing that more and more in the payment, in transfer, in the bookkeeping. And there is a question of ultimate mass adoption, where, when, and who. I think this is still to be seen, and it's just going to depend on really the progress that we're going to see in next few years.
Awesome. Well, thank you so much. I think we've certainly got a lot out of this session. There were quite a number of questions that came in, people wanting to know, hey, what percent of the marketplace is illegal transactions? You'll hear awful lot of things depending on your source. How stable are these stable coins? All kinds of different pieces to it. So we'll certainly follow up on some of those. Maybe I would like to leave with one that I thought was very appropriate. Okay, somebody's heard this. You've covered through these three areas: blockchain, what's going on. You've talked about a few of the big names in there. People were asking questions on some of the others when you mentioned a few names. Where can somebody go? What would be a good resource to get additional information beyond, obviously, going through any of the papers that you've put out there on this topic?
So there are quite a few. The issue is trying to find something that is reliable and has some sort of credibility. So honestly, on my side, I'm working night and day on this. If you look on my webpage, there are multiple articles on DeFi and on this space, just to give you a sense. I'm launching a new course in this space on Harvard Online as well. Things that are that don't really have our stamp of approval. I would say one thing that I found is helpful is going on some of the biggest name in this industry. For instance, Binance, which is one of the largest exchanges, have a very nice website where they explain you some of the main concepts behind it. I think they call it the Binance Academy. And those are definitely resources that are factual, and they are useful to have a look at as you learn more and more through it.
Okay. Awesome. Well, great. Well, thank you very much for that. And a few people noted early on, they said, hey, did you directly answer, is crypto its own asset class? So I'm not going to put you on the spot. Maybe that's sort of an afterwards, but it does revolve around those three things we talk about. What should the role of an investment be in your portfolio? That's something each and every one of you is going to have to answer on your own, for yourself, for your clients. Where does this fit in? You're going to have to ask yourself, what is the expected return? You just heard an awful lot of information there and a lot of volatility. Pretty hard to put a measure on that at this point. And then the cost structure, which we didn't totally get to, it's still pretty expensive. In fact, some areas to own it directly, it's very expensive, particularly in the US in some cases. So all things that you're going to want to think about in that overall portfolio. But any final thoughts on that, the asset class question?
So I think that it is still debatable. There is one line of thought that thinks that this is, one in particular is digital gold. There are others that point out that, Bitcoin has, gone through significantly higher volatility. But, if one takes sort of a step back and think about this as a larger industry, not just through the lenses of Bitcoin, I would say it is shaping as more and more of its own asset class. We are far away from, the levels of stocks and bonds, real estate, and so on.
Awesome. Well, that's all the time we have today. Certainly want to thank Professor Maggio for an excellent conversation there. Hope that was really helpful to everybody. Again, apologize we didn't get to every question on that. We'll certainly follow up with some of you directly if you're working with us. On that note, I'll go ahead and close this out. I'm Joel Hefner. Thanks so much for watching.